I'm going to go over in this video is exactly how I present full mortgage payoff. It's a very simple 1, 2, 3 step process. And what I'm going to do in this that's a little bit unique is I'm finding money that they're already saving or spending on things that I can reallocate, I can reposition. What I've found is a lot of people compartmentalize their spending. They might only have about $100 in mind that they're gonna be able to afford on insurance, or $50 a month. But if I can find other places they're already spending money and reposition it, I can take my average premium from maybe $1,000 APV to $3,000 APV average. And you're going to start uncovering things where people are spending $500 a month. You can get $1,000 a month EIUL, things like that. So what I'm going to do is I'm going to start. This is what I draw on the paper. I'm going to, let's say the client's name is John and Mary. Okay, so John is 40, let's just say. Mary is 39. I'm going to find out if they have any life insurance. John, do you have any life insurance that you own outside of work? Not through work, but something that you own. And let's say he's got $200,000, and Mary also has $200,000 of life insurance. And I want to know, when does that expire? Because if it expires in 2 or 3 years or 4 years, I'm going to potentially try to take whatever money they're spending and reposition that into a permanent policy. So let's say they have a policy that that expires in less than 5 years, 4 or 5 years, and they're spending $100 a month for him and $80 a month for her. Okay, so I'm gonna fast forward to the presentation past. We've already talked about qualification form. We've already gone through the medications. I've already asked, why did you guys fill this out? What's your main concern? And I've dug into that, kind of painted the picture, looked at what's life going to look like if one of you were to pass away. And I'm fast forwarding past that, and I'm going to say, like I said on the phone or earlier, I work with over 3 dozen different carriers, and each carrier tailors to different types of people. Some are really good for diabetics, some are good for heart issues, some are great for smokers, others just want to work with young and healthy people, more like yourselves. But all these carriers, they have different benefits, different options that they offer. So I'm going to go over all the potential options that you guys might qualify for. And based on what you tell me is important to you and what's not important, it'll let me know what direction to go. Okay, so when I go through these options, you just tell me what you care about and what you could care less about. Okay, so the first option is a death benefit. And this is kind of similar to life insurance in that, you've got this $200,000 mortgage. Let's say it's a 30-year term. And you pass away, it's going to pay off the $200,000. Okay, now the old mortgage protection used to only pay off the balance of the loan. So if, let's say in 15 years, you don't owe $200,000, you only owe $120,000, that's all it would pay off. The new mortgage protection, this kind of a policy, would pay out the $200,000. So even if you only owe $120,000, it's going to pay off the $120,000 that you owe and leave another $80,000 for each of you. So if that's all you care about is a death benefit, that's going to be the cheapest, most basic option. Okay. Now there's another option, living benefits. And I would say that 90% of people add living benefits. You're much more likely to use this policy with the living benefits, but it also only adds maybe 10 or 15% to the cost of the premium. So let me explain how that works. Living benefits would cover things like critical illness, so a heart attack, cancer, stroke, heart surgery. So if one of these things happens and you don't die, you can still access up to about 90% of that $200,000. And then I always share a story here. So if you've got a personal story, if you know somebody, person that could have used this, if they maybe had a heart attack or stroke or cancer. Last year my dad had a heart attack, and it was totally unexpected. He's in good health. We were actually flying him over to Ireland, one of our carrier trips with EIUL, and we met in Pennsylvania. And as I'm in line to get onto the plane in Ireland, he lands and calls me while we're in Pennsylvania. He says, I can't go. I thought it was because he was running late. What happened was, on the plane, he started throwing up blood, a lot of blood. And come to find out, he had been taking too much ibuprofen for knee pain, and it caused a internal stomach bleed, a little like burst blood vessel in his stomach. And he was throwing up so much blood. When I got over to the terminal where he was in a wheelchair. with about 10 paramedics and police officers just covered in blood. So we rushed out to the tarmac, get on an ambulance, and he was there in Pennsylvania for almost 3 weeks. One thing after another was happening. He lost about half his body weight in blood, almost died from that. They were able to cauterize the burst blood vessel, and because he had lost almost half his body weight in blood, it put so much stress on his heart that he had a heart attack. Then he had a pulmonary embolism. He had to have a pacemaker put in and a stent. Well, after all that, the good news is 2 months later, he's back to work, right? He's in great health. Everything's fine now. And what happens is a lot of the times people have these, cancer, heart attack, stroke, these critical illnesses. 80% of the time, people live through it. They don't die from it. It's like a routine oil change nowadays. But the reason he went back to work in 2 months is because he had to financially, not because he should have. So if he had a policy like this, by having the heart attack, depending on the severity, he could have accessed potentially up to about $180,000 of this. And I can tell you for a fact that if he had a check for $180,000, he would not have gone back to work in 2 months. He would have taken at least 6 months off and recovered and wouldn't have had the stress that he had financially. So that just gives you a lot of flexibility if something were to happen. And I know you're only 40 and 39, so that may not be a big concern. But you got to remember, you've got a 30-year mortgage. So you're going to be about 69 and 70 before you have the house put up. So you got to think about what could potentially happen over the next 30 years. Okay. So the third option, before I go over that, I want to explain kind of your different options, because there's a couple different ways you can get the death benefit and living benefits. And I don't want to bore you with a bunch of insurance details, but I also don't want you to end up like a lot of my clients that are 65 and 70. They've had a policy for 20 or 30 years, and their rates end up skyrocketing or canceling altogether. And I sit down with them and they're frustrated. They say, I wish my agent 20 or 30 years ago had gone over all the options with me, because I probably would have made a different decision. I probably would have gotten a different type of product, because they didn't like the idea of throwing that money away by not using it. Okay, so let me explain your options. You can do both death benefit and living benefits with what's called a term policy. Okay, all that means is it's good for a term. You can do a 10-year term, 15-year term, 20-year term, or a 30-year term. So we can get a pen to work here. So you got to change it back to blue. Okay, so or a 30-year term. Now, because you have a 30-year mortgage, I would probably, if you're going to do term, I'd probably get a 30-year term. So what that means is the rate is locked in, it's guaranteed for that 30 years. Okay, now if you decide, if I show you 30-year and it's a little bit too much, we can always go down to a 20-year or a 15-year. So the rate will be guaranteed for 15 or 20 years. And some people are okay with that, because you may end up paying extra on your mortgage, get it paid down in 20 years. So 20 years may be okay. So we can look at that. If the 30-year option, the longer that guaranteed rate is good for, the more expensive it's going to get. But overall, term is going to be your cheapest option. Okay. But again, a lot of people don't like the idea of paying an insurance company for 30 years or 20 years, and if you don't die, if you don't have a critical illness, you don't have anything happen, then you've given them a lot of money with pretty much nothing to show for it. So if you don't like that idea, you can do the third option. Third option is more like a savings / growth. Okay, this works similarly to an investment. It's not an investment. You got to make sure you clarify that. But it works similar in that when the market goes up, your money grows. When the market goes down, your money stays level. Let me explain what that means. So the money that you're paying for a term policy is a true expense. Okay, term is the cheapest, but it's the most costly. What do I mean by that? It's a true expense, just like your car insurance or health insurance. If you don't use it that month, it goes away, right? A portion of your premiums you pay every single month go into an account, and the 30-year average is that it's growing by 7.2% per year. That's the 30-year average. Okay, so let me explain how that works. Are you guys currently saving money anywhere right now? Are you saving money in a 401k, in a savings account, IRA, checking account, kids' college funds? Are you guys currently saving any money? And a lot of people are. They might say, yeah, I've got a 401k. Okay. In your 401k, how much does your employer match? Let's say the employer matches 5%. Okay, and how much are you contributing to that? Are you putting in just the 5%, or are you putting in more than the 5%? A lot of people are putting in more. Okay, if they're just putting in the 5% and they're getting the match, that's perfect for them. If they're putting in more, I'm going to write this down. I'm going to say, let me tell you what the biggest benefit of a 401k is that you're getting free money from your employer. Every time you put in 5%, you're getting 5%. So you're doubling your money every single time. Outside of that, it's one of the worst places you could save for retirement, because it's heavily feed. Every time, it doesn't matter if the market goes up or down. When your money grows or if you lose money, you're getting charged typically between 1.8 and 2.5%. So even if you're losing money, you lose 5%, 10% in the market, you're getting hit with another 1.8 or 2.5% fee from the 401k company. Okay, but you're getting the match, so that's good. But if you're paying anything over that, so if you're putting in an extra 5%, there's much better places that you could be saving that money for retirement that you're not going to have all those fees. Okay, so I want to know, how much do you make per year? What does that 5% equate to? So let's say they make $100,000 a year. Okay, that's $5,000 a year that they're saving in their 401k outside of that match. It's just they're just putting the money in there and not getting any other benefit, like the employer match benefit. Okay, so I'm going to take that $5,000 and I'm going to try to reposition it into this. Okay, I had a client just the other day that said, well, we're saving for kids' college funds too. We've got $300 a month that we're saving times 3 kids. That's another $900 a month, which is what, $10,800 per year. I'm going to do 3 EIULs, 1 on each child. That's another $10,800 a year that I'm going to put into this bucket. Now they may be saving. I had a client recently say we're growing our checking account by about $1,000 a month. Okay, they aren't earning any interest there. So again, I'm finding money that they're already. See, again, like I said in the beginning, people compartmentalize their money. They're okay spending $100 a month on insurance. They don't want to spend $10,000 a year or $1,000 a month on insurance, but they will use that for retirement, for savings, for just in case. So I explain, this 7.2% is a 30-year average. So let me explain what the difference is between like a 401k, which you're used to, or an IRA, or normal retirement accounts. They're doing this, right? This is what the market's doing. And you're hoping that over time you'll see a nice average return. Problem is, like my parents in 2008, they're ready to retire and their money's down here. So they had to postpone retirement to get their money back up. They lost almost half the money in the market. So a lot of people, they're not comfortable rolling the dice and putting the retirement on red, spinning the wheel, and hoping that things turn out okay for retirement. So what happens with this is the money that grows in this account, you're gonna take advantage of the growth in the market, but when the market goes down, you're gonna stay at zero. It's gonna be level. You're not gonna lose any money. It's gonna go up, and so it's like a stair step. So you've got much better guaranteed. The growth is much more consistent. Number 2, you can access this money whenever you want to. Your 401k, have you guys had to take a loan out against it to use it at all? A lot of people have. So if you ever want to use that money, you got to pay interest to the 401k company. You got to potentially, if you take the money out, you're paying a 10% penalty to the IRS. So you've got all these limitations. You can't touch it really until you're 59 and a half, almost 60 years old. You can't touch it. This you can access whenever you want. So if you guys need to use it, like I said, kids' college funds, if you need to use it to remodel the kitchen or whatever you guys need money for, the only difference between this and a savings account at the bank is you can go down to the bank today and withdraw some money. This is going to take about a week. Okay? So here's the way it works. By having this kind of an account, by having the EIUL, it automatically comes with a death benefit and the living benefits. So the more you save, the more benefits you get. The less you save, the less benefits you get. So I've got doctors who will save $10,000 a month in an EIUL, and they'll use it like their bank account. If they need money, they take money out. They save it. They want to save money. They just put it back in. They use it like a bank account. And because of that, they're going to have a couple $1 million of death benefit, and they're going to have the living benefits. The less you save, I've got some people that save, $25 to $50 a month for kids' college funds, and it's going to come with a death benefit and living benefits, and they're going to be smaller. So There's a couple ways to approach this. My advice would be to take that 5% you're paying, you're not getting any extra benefit from the employer match, and shift it into something that gives you more consistent growth, full accessibility, tax-free growth. That's what you're going to get here. You're going to get tax deferred with 401ks, but you're going to get tax-free. So all the money that grows, you're going to be able to access that tax-free. It's a big difference than having to pay taxes on that money down the road. So I would take that $5,000, put it into an account like this. You're going to get all the benefits, and then what you're doing is just repositioning the money. You're not having, in a lot of cases, you don't have to have them spend any more than they're already spending. You're just repositioning. In some cases, you might. Again, we've got this $100 a month up here, $80 a month up here, so we've got another $180 a month we have access to. So I'm finding all this money and just shifting it, and it becomes a very simple, easy to understand for the client. They become usually very excited about it. And what happens in turn, not only are you going to take your average policies from maybe $1,000 or $1,100 a month to $2,000 or $3,000, $4,000, you're going to find cases like this where you're going to get $10,000 to $15,000 a year in some cases. But you're also going, by adding so many other things to this policy, it's not just a mortgage protection policy. You're adding in savings and retirement. You're adding in death benefit, living benefits. What you're doing is you're adding so much value that people will keep it. It's gonna stay in the books. It's the reason that out of the last 12 months, my net placement rate is 90%, meaning every 10 policies that I write, 9 of them get issued, get placed, get paid for, and they stay in the books for at least 12 months or more. It's very, very high, but it's because people will cancel their insurance, but they're not going to cancel their retirement and their savings and their death benefit and all these other things. So, once I go through these 3 options, the way I'm going to transition into writing the application, which is important. It's one thing just to explain these options. The way you transition is say, okay, now based on where you guys are at, based on who you are, where you're at, what are the which ones on here would you say would be of interest to you? Do you like number 1 and 2, or number 1, 2, and 3? And almost everybody is going to say all 3 of them, but as long as it's affordable. And I'll say, of course, as long as it's affordable. So let me explain as far as a cost goes, because everything, obviously, it has to get the coverage you guys are looking for, number 1, but number 2, it has to fit in the budget. And I say, yeah, it has to fit in the budget. Okay, so I'm gonna show you what the cost is going to be for all 3 of these. The way I want you to look at this, though, is how much is your 401k costing you right now? You're putting in 10%, right? That's $10,000 a year. Does your 401k cost you $10,000 a year? Well, no, it's your money, it's savings. So if you move money from your left pocket to your right pocket, does that cost your left pocket money? Well, no, it's your money. You're just repositioning it. So that's the way I want you to look at this. So, if you just did 1 and 2, that's an actual cost. 1, 2, and 3, it's your money. You have access to the money. It's not a cost in the sense that number 1 and 2 would be by itself. Okay, but you do have to be able to cash flow it. You have to be able to afford to save a certain amount of money, right? So what I'll do is I'll show you. There's 2 ways to approach this. One is we can say, okay, how much do I need to save in order to get $200,000 of coverage in order to cover the house? Or we could say, okay, you're already saving $5,000 a month, and it obviously makes more sense to save it in a place like this than it does to a 401k. So let's go ahead and reposition this $5,000 a year. How much death benefit does that get me? It might give you $300,000 or $400,000, $500,000 of coverage. So which way would you prefer to look at this? Do you want to just say, how much do I need to save to cover the $200,000? Or do you want to look at this as how much death benefit and living benefits can I get for what I'm already saving? And so based on how the client answers that, I'm either going to look at, I'm going to figure the numbers that way. But let's say you get down to it, and they look at $200,000, and it's $220 a month on him and $180 on her. And so they say, okay, so together this is $400 a month. And they may say, oh yeah, that's no big deal. We're already saving money. We'll go with that option. But if they say, we just can't afford that, it's just too much. Okay, I'm going to look at 2 different options. I'm going to figure in either, okay, we can do all 3 on him, but maybe on her we just do 1 and 2, and that might drop the rate down to $60 a month because it's not getting the savings. You're just getting the insurance, and so now you're at $280. Okay, that's affordable. So I might play around with that. I might say, okay, maybe we can't afford the whole thing with an EIUL, but they like the idea of doing some of it. I might do 100,000 of term and another 100,000 of the EIUL, and that might drop the overall. So they're still getting the full coverage, but it's costing them less. So you just kind of play around with it. Maybe do some term and some, savings. Now, worst case scenario, they just can't afford any of the savings, but you don't want to make them feel bad that they're choosing term. So you say, let's start with term because that's affordable. I came here to protect the mortgage. $200,000. You like the idea of the living benefits. You can always convert. That's the great thing about the term is down the road, 3 years, 4 years, 5 years. If you guys end up paying off some debt or maybe get a raise with your job and you want to start saving extra money, you can convert the term to the savings at any point. Okay, that way they feel comfortable with the term. And once I kind of narrow down what they can afford and what they're looking for, I say, okay, great, let's start here, and again, we can make changes down the road. And I immediately get the application out and I start filling it out. So that's how I do it. Hopefully that helps, guys.